Alright, so in this video, we'll be discussing about finance company or financing company. So we have here an article from encyclopedia.com, and let's begin with the definition. So a finance company is an organization that makes loans to individuals and businesses, right? Unlike a bank, a finance company does not receive cash deposits from clients, nor does it provide some other services common to banks such as checking accounts, okay? So finance companies make a profit from the interest rates, the fees charged for the use of the borrowed money. They charge on their loans, which are normally higher than the interest rates that banks charge their clients, okay? So finance companies as a non-bank financial institutions, of course, they do not accept deposits and they do not offer the other services that are common to banks, okay? As a finance company, what they normally do is they make loans to individuals and businesses. And as a non-bank financial institution, normally they also charge a higher rate of interest compared to banks. But when it comes to requirements for individuals and businesses to be able to borrow money from them, they have a less strict or their process of for the application processing is less strict compared to the banks, okay? So in a way, with regards to people, individuals or businesses, especially small businesses who are unable to borrow money from the bank, so their next option would be to go to finance companies, okay? They have other options, we've had pawn shops, and then there are also lending companies that we'll be discussing later on. But again, finance company is one of their options, right? Many finance companies lend to clients who cannot obtain loans from banks, yes, because of a poor credit history. So this is one of the reasons. The record on an individual's payments to the institutions who have loaned him money in the past. Okay? Here in the Philippines, we don't have yet the so-called credit rating, but there is some sort of database that financial institutions are using wherein they can access and check whether an individual has a poor credit history or not, okay? And then there's another one that's starting. GCash is starting with their G credit score or credit score or something, right? Which they do use so that they could assess the financial capability and financial history with regards to the transactions of their customers, because they do provide some sort of G credit, some sort of loans to their clientele as well, right? Such clients secure their loans with finance companies by offering collateral, so by pledging to give the company a personal asset or possession of equal value to the loan if payment on the loan is not paid. So something like a car or jewelry or title to a house and lot, okay? Their difference with the pawn shop is that pawn shops normally have shorter credit terms, like a few months only, but finance companies, they can do short term and long term as well, like 1 year, 2 years, up to 5 years, I think. Okay, so here's an example here. Okay, a borrower for $5,000 from a finance company. So cover the cost of starting a house painting business, the finance company might ask that he offer his pickup truck as collateral. So in case he defaults in payment, the finance company could take possession of the pickup truck, okay? So it's some sort of security for the finance company because they are also taking on a much higher risk compared to banks. In a way, the banks, they can offer low interest rates because they have a tedious process, they have strict requirements, and in a way, their borrowers, there's less risk that their borrowers would default in payments, okay, compared to the finance companies, because the clients normally have poor credit history, or if possible, though they do not have a credit history yet, so they have no proven track record yet, so the banks are not accepting them as well. And then when it comes to new businesses, banks normally require that you present at least 2 years or 3 years of previous year's operations, financial statements. So if you're a new business, if you're a startup, you cannot actually provide those documents, so you cannot borrow for business purposes from the banks. So the option would be to go to finance companies, right? Okay, some large companies own finance companies that provide clients with loans to purchase goods from the large company. So under this arrangement, the large entity is called the parent company, and then the smaller entity is called a subsidiary or a captive finance company. Example of this would be General Motors. They have General Motors Acceptance Corporation. So if you want to buy a product of General Motors, especially those that are highly valued, so you can go through General Motors Acceptance Corporation and then get a loan from them. And then in a way, the collateral that would be taken would be the product itself, that is being sold, right? So in case of default, the product would simply be repossessed. Okay, so normally the products of these companies are vehicles, automobiles. So you have General Motors, Ford Motor Company, they have Ford Motor Credit Company, and then you have Daimler Chrysler. They have a finance company called Daimler Chrysler Financial Services. Okay. So let's look a little bit on the history. So when did it begin? General Motors was the first of the big three American auto manufacturers to open a captive finance company, establishing branches of GMAC in Detroit, Chicago, New York, San Francisco, and Toronto in 1990. Okay, so there's a lot going on here. Okay. In 1985, the company earned $1 billion in revenues. That same year, GMAC began offering home loans, and soon after branched out further by lending to large and small businesses and by selling insurance. Okay. So essentially, they became very successful, right? Such finance companies as Allied Capital and the Money Store, which specialize in lending to small businesses, began operations as far back as the 1950s and 1960s. But these companies experienced major growth in the 1990s when Americans started borrowing larger sums of money for both personal use and for their small businesses. However, as lending increased, more people defaulted on loans and filed for bankruptcy. So they they saw growth and they catered to more and more people, and they increased the amounts that they can lend to these individuals and businesses, right? Unfortunately, these businesses not only use the borrowed money for the business, but for their personal use as well. So in a way, it did not go to profit-making activities or revenue-earning activities of their business. So more people defaulted on loans they could not pay, and they filed for bankruptcy. And so these finance companies suffered, and then which made banks reluctant to continue lending money, especially to small companies that were unlikely to remain in business. Okay, so this was the history with the banks, Allied Capital and Money Store, right? And then this created a large pool of loan candidates for finance companies. The banks essentially became, that's how they came up with their stricter requirements, and they wanted to ensure that the borrowers do have the capability to repay the loans, right? They wanted to protect their money because essentially their money come from depositors, right? So they are also being regulated currently more strictly than other non-bank financial institutions. So for finance companies, of course, the money came from the investors or the owners, but it's not essentially from public money or from a lot of people, members of the public. So they do not have that much regulation with regards to, having stricter requirements before issuing loans to individuals and businesses. Okay. So what happened was when the banks became stricter with their requirements, so all these people who cannot borrow from them turned to finance companies, right? For example, in 1996, 37% of the small business owners in America requested loans from banks, and 25% of these were rejected. Companies like Allied Financial began providing loans to these clients at high interest rates. So essentially, the reason why they do charge higher interest rates compared to banks is because, they have a higher risk as well that these people might not be able to pay back the loans. Okay, so in exchange or to offset that kind of higher risk, so they are also charging higher interest rates. Okay. More detailed information. Most economists separate finance companies into three major categories. So we have consumer finance companies. They make small loans to individuals, usually on terms that are unfavorable to the client. So, usurious interest rates, very high interest rates, okay? And then these businesses, which are also called direct loan and payday loan companies, have been accused of taking advantage of people who are in desperate need of cash, okay? Essentially, you borrow a small sum of money and then you pay it back within a short period of time, and yet the amount of money that the interest or the charge is a little bit high. Okay, it's actually high. A typical relationship between a direct loan company and the client might go something like the following. So the example given here is that the client needs $200 only, okay, and he has no other resource but to go to a finance company, a consumer finance company, right? So it goes there and then provides the company with a personal check or proof of income, pay slip, or recent bank statement. And then the finance company verifies the identity and the information provided, especially the fact that he's currently employed and with a possible source of income, coming in that will be used to pay the loan. Okay, so before leaving with the $200 in cash, the client writes a check for $230 and post dates it by 2 weeks. Okay, so that's $30 in 2 weeks. So that's around what? 30? No, sorry. How much is that? 15% in 2 weeks. Okay. Okay. This check will serve as collateral for the loan if the consumer does not show up to pay the $230. So the check would be encashed. Okay. Such company may also ask for the title to the customer's car to ensure that the customer does not close his checking account and leave the direct loan company with no way of getting value back for the loan. Though the $30 fee for the loan may seem fair given that the client needs the money, this charge amounts to 15% interest on a 2-week loan. Okay, so that's 15% for 2 weeks only. Again, the normal interest rate is 12% for 1 year. Okay. But this one is very usurious, 15% for 2 weeks, 390% annually. But then again, he can't probably borrow this amount of money from the bank or from anywhere else, okay? Loans that are offered for interest rates higher than the market average are called subprime loans because some direct loan companies demand even higher rates of interest. Many states in the U.S. have established small loan laws that cap interest rates on these subprime loans at around 25%. Okay, before here in the Philippines we had the anti-usury law, but it was some sort of abolished or not implemented because they left it to the companies and the consumers to agree on the interest rates that they want to charge, right? Because the client or the customer has the choice to not continue with the application for a loan if he feels that the interest rate is very high or usurious. Okay, so if he does not want to pay that much interest rate or that much interest on a certain amount of loan, then he can just say no and not continue with it. Okay, and find someone else that's going to offer lower interest rates. Okay, the second type of finance company is called a sales finance company or an acceptance company. So essentially, you have this business which is selling high value items, probably vehicles or machineries. And then what they do is that acceptance companies provide a service for businesses that is similar to the service direct loan companies provide for individuals. It's almost the same, but normally for small businesses, right? First, businesses that conduct transactions with acceptance companies are large corporations with high credit ratings. Such corporations are not asked to secure their loans with collateral. Normally, the products that are going to be purchased with the loan would serve as a collateral. Second, in these transactions, the businesses usually receive interest rates that are equivalent of are slightly better than rates they would receive from a bank, okay, because these are, again, large corporations with high credit rating. So they do have a track record of good credit, okay. In many cases, the terms of the loan stipulate how the business can allocate the borrowed funds, for example, to meet payroll or to purchase inventory. Businesses cannot use these funds to do such things as build a new plant or buy additional real estate. The sums involved in these loans are quite large, often in the millions of dollars. So again, some sort of short term for the needs of the business. But in a way, they are expecting that, they have money coming in, but currently they're short on cash. So they go to finance companies, sales finance company, okay, so that they could meet the obligations of paying either the supplier or their employees, okay. But there is a restriction or a condition that the purpose of the loan can only be used for the purpose that it was applied for, right? They cannot use it for other purposes. So sometimes they would be required to present a document showing that the money borrowed from the sales finance company was actually used for the purpose that they have been applied for, all right? Commercial finance companies, which are also called commercial credit companies, are the third type of finance companies. So this is the last one. They make loans to small and large businesses, often to help them cover costs for new equipment. Because they represent a greater risk for the commercial credit company, small businesses often pay higher interest rates than large businesses, because large businesses, they do have, more assets. So in a way, that's less risky. So in case they default in payment, they can just, take it out from the assets, okay? There's a source of the money to repay the loan in any case. The interest rates on these subprime loans tend to be between 0.1 and 0.6% higher than prime rate loans, which are the loans given by banks to more financially qualified clients. Though this may seem like a small difference, these percentage points often translate into thousands of extra dollars in revenue for the finance company. Okay, it's a small percentage, but if the principal is a large amount of money, then that would translate to large sums of money, right? The finance companies often need this extra money from their paying customers. However, because they tend to have a greater number of delinquent clients than banks have. Okay? So this is the reason why they also charge higher rates of interest. Again, because they're taking on higher risk compared to banks, and probability-wise, they have more clients that default in paying the loans. Okay, so to absorb the losses or the so-called delinquent accounts, so they need to charge higher interest rates, okay, especially to the paying clients. Okay. Do we have more recent trends? Though banking institutions remain the most popular source of business loans, yes, many Americans seeking loans for small businesses have begun to prefer finance companies to banks, because finance companies are less concerned with their prospective clients' credit history, yes, and they do not require that much paper documents, right? This means that a finance company is more likely to approve a loan request than a bank, and that a finance company will be apt to lend more money for longer periods of time than a bank. Okay, small business owners generally request loans from finance companies to purchase inventory from wholesalers in exchange for favorable terms on a loan. Finance companies often require small business owners to make their assets available as collateral, which is pretty much normal. Commercial finance companies grew steadily throughout the 1990s, and by the end of the 1990s, they were the second largest provider of business credit in the US. Okay, and then they have these other information. So essentially, this is the second best option after banks if you want to finance your small business, okay? Or, if you have emergency cash needs, salary loans, you can also go to a finance company, all right? And then if you're a big business as well and The banks do limit big businesses as well, because they have caps or they have limits being imposed on them. So sometimes these big businesses cannot also be satisfied with the terms being imposed by banks, so they also go to finance companies. Again, just sometimes. All right, so this is it for this one. We've tackled about financing companies, the 3 types of finance companies, and then the nature of their operations. All right, so that's it for this one. Thanks and bye.